The One Big Beautiful Bill Act just rewrote huge sections of the tax code, and if you're a high-income W-2 earner, business owner, or real estate investor, this can mean massive tax savings or costly mistakes. From the return of 100% bonus depreciation, to changes in the QBI deduction, to new deductions for tips, overtime, and auto interest, as well as expanded estate tax exemptions, this video breaks down exactly what you need to know and what to do about it. Let's start with a quick overview. The One Big Beautiful Bill Act, or simply the One Big Beautiful Bill, is a sweeping tax reform package that was passed in 2025. While it grabs headlines for making 100% bonus depreciation permanent, it also locks in existing tax brackets, introduces new deductions, and expands estate tax exemptions, as well as provides strategic benefits for both individuals and business owners. If you're a high-income earner in a high tax bracket, this bill is something that you must plan around, and that's exactly what we're going to be diving into. Starting off with some good news, the 10 to 37% tax bracket structure is now permanent, no sunset in 2026. The increased standard deduction is also here to stay, currently at $31,500 if you're married and filing jointly, and $15,750 for singles in 2025. And this, of course, will be indexed for inflation. And this creates tax planning certainty, no cliff to worry about. Next up, we have three new above-the-line tax deductions that are here to stay at least through 2028. The first one to be no tax on overtime, which allows you to deduct up to $25,000 in qualified overtime pay if you're married, or up to $12,500 if you are single. And this is phased out for incomes above $150,000 if you're single, or $300,000 if you are married, and that is adjusted gross income, or AGI. Moving on to no tax on tips, which is also capped at $25,000, and this is great for high-income service workers in tipped positions. Moving on to the auto loan interest deduction, which allows you to deduct up to $10,000 in interest, but the car must meet specific qualifications, including final assembly here in the United States. And this is phased out if your AGI is above $100,000 if you're single, or $200,000 if you're married. But these are not forever. They will expire after 2028, so make sure you plan now. Well, I have an entire video dedicated to this topic. Here's the short version. Starting January 19th, 2025, qualifying property can now be fully deducted in the first year that's acquired. Think real estate deductions via cost segregation studies, business equipment, vehicles, and improvements. There's no phase out. It's 100% and it's permanent. For short-term rental owners and real estate investors who qualify for non-passive treatment, this is a massive tax savings opportunity. I'm talking about tens to hundreds of thousands of dollars in tax savings. This is big and cannot be understated. Again, check out the full video on bonus depreciation for more details. The 20% qualified business income deduction, or QBI for short, is still here and better than before. Phase outs now start at $100,000 if you're single and $150,000 if you're married filing joint, up from $50,000 and $75,000 respectively. Specified service trades or businesses, or SSTBs for short, such as health, law, accounting, consulting, financial services, and others, still face limitations. The planning window just got wider. Real estate professionals, short-term rental operators, and agency owners benefit the most here. The estate and gift tax exemption is now permanently increased to $15 million starting in 2026. That's up from about $14 million with no cliff. This is great for lifetime gifting, grats, dynasty trusts, and multi-generational plans. The rules for qualified small business stock, or QSBS for short, just got even better. If you hold for 3 years, the gain exclusion will be 50%. If you hold for 4 years, your gain exclusion will be 75%. And if you hold for 5 years, you'll receive 100% gain exclusion. Now, this is capped at $15 million, but that is a pretty generous cap, and the asset limit goes from $50 million to $75 million. Founders and early-stage investors in C-Corps should consider holding periods and planning exits accordingly. Moving on to some more real estate and business owner-friendly incentives, the Section 179 expensing limit has been raised to $2.5 million with a phase-out that starts at $4 million. The interest expense deduction is now fully based on EBITDA permanently, which is great for real estate syndicators and funds. Domestic R&D is now fully restored, meaning you can deduct it all in 1 year and no need to spread it out over multiple years. Lastly, the excess business loss limits. These limit the amount of losses you can take against non-business income, such as W-2 earnings, is now permanently deductible as a net operating loss in subsequent years, or an NOL for short. And this is a huge win for high-income filers with active real estate or business losses that they are generating through those activities. All right, so here are your next steps. First, revisit your entity structure. Also, if you own real estate or are thinking about owning real estate, consider a cost segregation study for massive tax savings. Again, I do have a full video on 100% bonus depreciation here on the channel, so make sure to check that out. Also, if you're planning to gift or invest in early stage companies, now is the time. Also, schedule a proactive tax planning session before year end so you're not missing out on critical and significant tax savings opportunities that come with this new bill. And if you want help building a custom plan around the One Big Beautiful Bill to maximize tax savings for your specific situation, book a free discovery call with our team. The link is in the description below. Also, don't forget to like, subscribe, and check out the other tax strategy videos here on the channel, especially for the full breakdown on 100% bonus depreciation. And if I missed anything or you have any questions, drop me a comment and I'll answer in the comments below.